Can you all see my screen, please? I hope so. Okay. Now, my name is Sawyerr. I work as a management consultant. I work as an associate for Ubele. And I've been providing one-on-one support as well as delivering some of the webinars. Okay. Today, I'm going to try and talk about cash flows and financial management. And the session will be in 3 parts, which are integrated. The first part would explain what a financial statement is. That's fairly brief. And then I'll go on to explain the different elements of a budget. And then I'll expand on how the budget is translated into a cash flow statement. Okay. It's probably a long drawn session with a lot of figures, but what I'm going to try and do is to give as many examples as possible so that you are able to understand what is going on and you are able to construct a cash flow forecast. Okay. In doing any fundraising, the important thing is to think about your next application. And when thinking about your next application, it's important to think about the fact that all your final accounts are ready and tidied up to go. Because invariably, the funder would ask you for your performance over the years. And they judge this by the cash flow forecast and the final accounts that you present. In most cases, they ask for audited accounts. But if you're a small organization, they may just ask for an account that has been approved by an independent auditor who would just have looked at it. We also need to ensure that our management accounts are up to date and that during the period of the funding, at least the next 6 months, we have cash flow forecasts that show how it is that we are going to perform. We want to make sure that our budgets are accurate and reasonable so that if comparisons are made with organizations such as yours, your budgets will not be out of kilt. We want to make sure that we've covered all our costs. Often, small groups chase after a lot of projects and lots of funding. And the problem they have is that they are delivering funding all over the place without thinking of the support of the organizations themselves. So you end up delivering a lot of projects and then not really having enough money to support the organization itself. We also need to show that we have a track record of delivering. Not just delivering, but a track record of reporting what it is that we have done. Now, the financial accounts are really what reports our performance over the years. And then finally, we need to ensure that our system of accounting is a robust system so that all the expenses are recorded and that we actually have something that is up to date that shows that we are ready to be able to absorb funding. Okay. Now, let me try and talk about the 3 types of financial statements that people often get. And I joined the 2 of them. The income and expenditure account shows your performance. So it shows what monies come in and what monies go out. And if there's a surplus, it shows the surplus. And if there's a deficit, it shows the deficit. The income and expenditure account actually measures performance of your organization. The balance sheet shows the wealth of your organization. And what that means is that if you take out your fixed assets, if you have your fixed assets and you have your current assets and you take out your current liabilities from your current assets, What is left over is really the worth of the organization, which in everyday parlance, we talk and term as the reserves of the organization. Cash flow forecast is a test of the health and liquidity of the organization. It means that you don't run out of cash before the project ends. And it shows a measure of your sustainability over the years of running the project, that at every point you have a healthy cash flow forecast. Okay. Now, so I start with looking at what I'll call the financial statement of the organization. And I'm going to try and explain it. I hope it's not very difficult for us to understand. Okay. This part of the statement is what I would call the statement of financial activities. It shows that in 2007, which is the year, our organization had income of £1,076,966. It shows that during that period, our organization spent £876,087, which means that if we take this amount from this 1 million, we end up with £200,879. Now, in simple form, it's about taking our expenses out of our income to see whether we are able to generate a resource, a surplus. And it is this surplus that we normally carry forward to the next year. But in this case, in comparing 2007 to 2006, we realized that in 2006, there was a healthy surplus that was generated by the organization of 412,132. We add that to the 200,000 surplus that we've generated this coming year, and our total surplus that we have for the organization is £613,011. This is what we will carry over into the next year. But there's an aspect of the financial statement that is supposed to provide better meaning. Some funds that we get are restricted funding, because those restricted what's happened? Hello? Because those restricted fundings are meant specifically for the organization and for particular use within the organization. We then have unrestricted funding. That is general funding that can be used for other things within the organization. And the statement of recommended practice suggests that we should keep these two amounts separate. So we should not be using restricted funding for any other project apart from what it is that the funders intend us to use. So this £613,011 is made up of a surplus of 522,102 which is unrestricted funding, and £90,899 that is restricted funding. Okay. Having explained what a statement of financial activities is, I will now go on to try and talk about the balance sheet. This is a consolidated balance sheet of the organization. And we have our current assets that includes cash in bank and some short-term investments. We have debtors, and so we have a total amount of current assets, which is £825,204. But we also have liabilities, and liabilities are creditors that fall during the year. So if we subtract the creditors from our current assets, we end up with net current assets of £558,000 and £17. And if we add that to our tangible fixed assets, which are normally made up of maybe the equipment and things that we have, we then end up with a total current assets less liabilities of £613,011. Now, that is what is represented here in the surplus that we carry over into the next year. And that is made up of our restricted funds, which we have here, and our unrestricted funds, which we have here. So both sides of the figures balance. We have a statement of financial activity that feeds into the consolidated balance sheet that shows that we have a healthy surplus of £613,011 that we can send into the next year. These are the final accounts that your funders would want to see from you, and they would like to see the progress that you're actually accumulating funds or spending funds wisely as we go on from year to year. I hope that if there are any questions, please delay the questions, and I'll come back to this slide if it's probably a bit confusing for you. Okay. Now we move on now to talk about a budget. A budget is essentially a financial statement, and it's really your own plan. You are building up an estimate of your expenditure, and you are building up a plan of what income is forecasted for the period. So if you are applying for funding, for instance, it's about saying that this is the amount we want, and this amount is made up of a budget that we have decided. Okay, and we've decided this budget based on estimates and also based on actual funding that we have. And I'll talk about that actual funding at a later stage in a little while. Okay. The issue about a budget is you want to make sure that at all times your income is more than your expenditure. And then you think about, what do we do with the difference? Are we able to invest the difference, or are we able to deliver more resources or more services because we have a lot more money? If you present a budget that is a deficit budget, then it's going to be difficult how you are going to be able to fund it. And we all know, we all budget. We budget based on salaries and income that we receive. And at this period, the chancellor is struggling in terms of looking at taxes that is going to raise, because it's been spending a lot of money during this period of COVID, where the economy is not as strong as it should be. Okay. A budget is making assumption about the future. And we have to be realistic about our future. We have to be realistic that if the future is bright, then that bright future should normally depend on past performance. So questions that funders ask you is that, why do you think that you are going to do this well when in the past you have not shown that you have done fairly well? And so in doing budgets, we have to remember that though we're making assumptions of a bright future, we are confident, we take cognizance of the fact that we are able to explain why the past has not been as good as we thought. We have to be able to judge the timing of our receipts. Now, that's important in terms of cash flows, because otherwise we may end up not being able to balance the books and going out of business because we do not have sufficient funding. In budgeting, what we also do is to be able to apportion our expenditure and allocate all our costs. And budgets change if you are doing a 5-year budget or cash flow. Budgets change to take account of things like inflation, knowing that we'll probably spend more money, or knowing that maybe conditions have changed. Most people who have presented a budget during this COVID period have realized that they may have ended up spending more money than they really do, and not getting enough coming in. And there are two ways of budgeting. Zero-based budgeting is normally used by organizations that are now starting out because there's a clean slate and they really don't know what is happening. But most people work on the basis of incremental budgeting because they have some basic figures of what has happened in the past, and what they don't have, they can go and look for. Okay. Now, part of budgeting is how we forecast our income. And in forecasting our income, we need to be able to, based on what we've accumulated in the previous years, if we've been prudent. And if we've not been prudent, then we need to look at maybe doing a lot more work in order to increase monies that we are going to get from grants, from gifts, from contracts, and from other aspects of trading, which form the basis of our proposed activities now. We must cover all our costs, and that includes covering our management costs and making sure that we are not running from project to project. And therefore, there's a concept of full cost recovery, which a lot of organizations now use, that for every project, they are able to assign money towards the management of the project, towards the review of the project, towards the reporting of the project, and towards the evaluation and final reporting of the project. Okay. Now, I've talked about the basis of a budget, but it's now important for me to talk about elements of the budget, the 5 main issues that constitute a budget. And in so doing, I'm also going to talk about how costs behave. Most budgets have, for the purposes of voluntary organizations that are delivering a service, would have staff costs, would have material costs, would have some element of capital expenditure, and will have some overhead costs, and also management and supervision costs that I talked about. Staff costs, we all recognize that the more we deliver services, the more we may need to employ more people. So our staff costs generally go higher, become larger if we deliver more services. The material costs also behave the same. The cost of buying things in order for us to be able to produce things will go up if we are serving more customers and more users. But in the general principle is that the unit cost of providing the service may come down, though the cost would be higher. And this is a technical point which I'll probably explain later. Capital expenditure, we need capital expenditure. Maybe at the start of the project. Capital expenditure is not something we do all the time. Capital expenditure we do once and we spend over the life of the project. Overhead costs are things that remain static for a period. There are premises costs, energy costs, communication costs, financial compliance costs, sundry items. This can hike up if there's suddenly a burst in increase in providing more services. And the management and supervision costs is about our planning, our monitoring, and our evaluation costs. So these are the 5 key elements of a budget. And I'll show how these elements relate to each other in the next few slides. Okay. 2 examples that I want to provide is an example of an example of a project that operates for 2 years, 3 years, although I'll spend 2 years of it. And I'll talk about the main elements of the budget, which I'm saying that whether it's a large project or it's a small project, it's really the same elements. And whether it's a project that spreads over a long period of time, like 3 years or 3 months, these are the same elements. So what I'm going to do in the next slide is actually to talk about a situation where a new organization is being set up and it's an advocacy project to deal with health inequalities that have come out of this period. And later on, I'll talk about looking at a 3-month project for school kids in this COVID period. Okay. I've tabled costs, I've tabled our projected income for 2 years. In the first year, we have funding not from a lot of sources. The funding we have from these initial sources are meant to help us kickstart the project. And so in that first year, our total income that we have budgeted is $97,840,000. In year 2, we expect to quadruple this amount because that is when our project will be operating at full strength. And that we expect that would be able to generate £407,000, £407,980. So this is really our income threshold, money from London Corporation, from Trust for London, Cabinet Office, Bridge House, Hilding Trust, and then money that we get in terms of gifts from other places. Okay. Then we look at our staff costs. And in this staff costs, we are looking at the fact that we would employ a development coordinator in the first year, and then we deal with a lot of consultancy support. So what we end up with is that our cost in the first year will be 37,000, and in the second year will be 157,000. But what we should remember that it's not just the cost of employing people. There are costs like advertising and selection costs when we are employing people, and there are national insurance and other benefits that we pay to people when we are running these projects. So in the first year, we have a total of £48,490. And in the second year, our staff costs are going to be around £204,000. So this is the first element of the cost that I talk about. Okay. These are actually material costs. And I just realized if I go back to the old slide, I don't know whether you can see that the staff budget is about 50% of the total cost of the project. Okay. Now, our project costs are now 750,000, 7,500 and 133,000 pounds. So in the first year, we do very little work. Although we've got a lot of money, most of the work is being allocated to really starting up. We are dealing with things like website design, seminar costs, consultation costs, and workshop costs. Okay. In year 2, when we've actually delivered the service, we realized that the costs are expected to go up to 133,000 pounds. And so the percentage in the first year is about 8%. And in the second year, we realized that the percentage of project and material costs goes up to 33%. Okay. And now we look at capital costs. Again, capital costs, we tend to spend more money in the first year, acquiring most of the things that we need to run, PCs, printers, etc., etc. We spend maybe about 13,400 pounds on equipment and 2,000 on furniture. So in the first year, we spend 16,130 pounds, and we spend less in the second year. Okay. And now we come to our overhead costs. Again, in year 1, we end up spending on rates, electricity, heating, meetings, telephone, apps, and so forth, so on and so forth, which are really the elements of what we would normally spend money on. And the total overhead cost comes to 25,720 pounds. In the second year, we spend more money because the project is now running out of speed. Okay. Now, these that I've mentioned before are the main elements, but we now have to spend money on how we'll be able to evaluate the project. And if you recognize, in year 1, I have not allocated any cost at all towards management, mainly because we are going to use that year in terms of setting up the project. But it is in year 2 that we put in an amount of 15,000 pounds that will then be used in terms of other management costs. Okay. Most trainees and board members are volunteers to our organization. They assist in planning our projects, but it's important that we allocate some costs towards them for the efforts. And sometimes those costs are given out to them as expenses, but in some cases, those costs are actually given out in terms of used as in-kind donations that will buttress the fact that our organization has a lot more resources, and in terms of matching funds and in terms of leveraging in more funds. Okay. So this in a nutshell is really what I talk about in terms of an example of budgeting. Now let me talk a little bit about the process of budgeting, because budgeting starts from requests based on the demands of our service users. It takes into account what we can deliver, but it's really based on the demands of the service. So if we know that we are budgeting for 300 people to provide a service, when we're making a request for funding, our request will be based on the fact that we are looking for this number in terms of delivery. The starting point of most budgets is really accurate figures. And those accurate figures are based on a profile of what we have done before. In previous years, we are then able to add on that there are things like inflation, or maybe the costs have dropped. And so we are able to adjust the figures accordingly. Then we're also able to examine what our management priorities are, because we may offer a service that does not have an increased take-up, and we may decide for one reason or the other to drop that service. But there might be a need for another service. So in budgeting, we also take into account the priorities of our management. Finance workers generally work on the budget. And when these are approved by the finance committee, they are then sent to the main board. And then they are communicated to management and staff. And our budgets must be monitored at all times, especially by the person who is the treasurer of the organization. Now, let me use another example, which is an illustrative case. Like in this COVID period, there's an organization that offers Black history and science electives at the weekend. But the younger children who accompany their siblings are offered Black art session. And I'm saying that in the light of children staying at home, how do we engage them? So I'm looking in this second case of a simple budget that will be run over a 3-month period for 30 children or for 60 children, as the case may be. Okay. So I'll take you through this example too. We make assumptions when we are doing a budget. So this assumption is that we need a new development worker who would be employed essentially on a part-time basis at the rate of £20 an hour, and this person will work for 3 days a week over the 3-month period. And then we would also employ some part-time session workers. And this will be critical depending on whether we are dealing with 30 children or we are dealing with 60 children. And they will be paid at the rate of £10 an hour over the same period. And then we budget in some volunteer expenses, which something like £10 a day for one volunteer. And if we need 2 volunteers, because we have 60 children, okay. And we've allocated 20% as on cost to take care of national insurance and other costs. Now, we have one development worker, whether it's for 30 children or it's for 60 children. They work 3 days a week at £20 an hour. We need a sessional worker when we have 60 children because there's more demand. We need an advisor who helps in terms of the initial setting up of the project. And that person is paid £500, whether it's for 30 children or it's for 60 children. Our volunteers, if we have 30 children, it's just one person. So we budget for 360. But when we have 60 children, we have 2 volunteers. So that goes up to 720. If we add this up and we add on the on-cost, which I've estimated at 20%, what we end up is, if we are working with 30 children, we would have staff cost of £5,568. But when we take in 60 children, our staff costs go up to £8,648. Okay, so this is how the basis for working out the staff cost. Okay. And then material costs. When we are dealing with 30 children, we only budget £600 for the arts paper and £150 for the crayons that we use. These double when we are dealing with 60 children, because what I said is that material costs tend to go up when we have more service or more people to deliver a service to. So that's how we work out the material costs. Okay. In terms of capital and equipment, they stay the same, because what we are doing is an extra service that is delivering something online to the young people. So cost of a camera, cost of a laptop, subscription to Zoom is fixed cost. Whether it's 30 children or it's 60 children, the amount of equipment will be £1,245. And then overhead costs. Premises remain the same, energy remains the same, communication costs increase because maybe we are doing more effort at outreach. And administration costs may also go up because we are doing more administration. So again, for 30 children, we have £450, but for 60 children, we end up with £650. The management costs will go up because what we have done is we've allocated 10% as management costs. So these are 2 projects, a total of £8,814 for when we are dealing with 30 children, but £13,247 when we are dealing with 60. I hope that I've explained in this different how the different budgets work and how the different elements of cost work, and that these 2 cases you can actually look back and review as to what I've done when you get the slides later on. Okay. The total indicative budget, and you will realize that I have percentages on the side. Really, the purpose of the percentage is that most funders receive applications from so many people, so many organizations. So they are able to compare the cost. And they realize that when you are running an intensive project, your cost of employing staff will be 65%, but maybe your overhead cost will just be really 5%. And maybe your capital cost will be 9%. So when you finish working out the cost, it's important for you to actually break it down to the different elements to see how those elements relate to the total budget that you have provided. I hope that you've taken in all this, but as I've said, you would have the slides to go and work through after this session is completed. Okay. Now, perhaps, let me talk a little bit about why I think budgeting is important. I think budgeting is important because it helps us to manage our cash and to control our credits. It helps us to have a tighter control of our budgets and a tighter control and enabling us to anticipate shortages and helps us to be able to generate a support. It helps us to be able to measure our performance. And if we are running an inefficient organization, it helps us to be able to take corrective action. And accurate budgets will help to determine how to take an alternative course of action when we do a review of the project. So moving on to from budget, I'm trying to look at a cash cycle so that we are able to look at how we do our forecast. It's a way of capital normally, or money that comes into the organization, is translated into assets. And these assets are in the form of debt, stocks, equipment. These assets are used to develop services. And income is normally generated if you are trading. And it is this trading that comes in, and that income is used to pay the creditors and to pay for some of our liabilities. And if it's a business like a social business, some of the residue is paid to our investors. But mostly, the surplus is retained so that we can invest in materials for more service delivery. And I'm saying that when we generate more income, we are able to provide more services. When we think about a cash flow forecast, what we need to do is to state all the underlying assumptions and be realistic about them. When we do business with people, or do people give us credit? Do we give people who buy things from us credit? Do we know when the loans that we take on are supposed to be paid and the terms and conditions of these loans? A cash flow forecast is not about profit and loss. That's what we think about when we are doing the income and expenditure account. A cash flow forecast is about looking at when cash comes in and when cash leaves the organization. So we don't include depreciation, but we may include VAT if we are registered for VAT. And the stages is that we determine what our opening balance is. We calculated We calculate our projected income, looking at the historical level. We look at changes in service delivery, inflation, VAT. We split the income between cash and credit. We calculate the projected income from debtors, and we calculate what our projected purchases will be during the period of the cash flow forecast. And again, we do a split between purchases in cash and purchases in credit. And then we calculate what our cash inflows will be and what our cash outflows are going to be. And the outflows, as I've stated again, are in terms of salaries, materials, overheads, capital, management fees. Okay. What we remember and is critical about cash flow forecast is that cash flow forecast is about timing. It's about when you pay out what money. So, for instance, people pay insurance yearly, but you may have an arrangement to pay for insurance monthly. People pay their taxes on a half-yearly basis, but again, you may make an arrangement. We don't receive all our grant once at the start of the project. Some are received on a monthly basis and some on a quarterly basis. When we pay out major utilities, we pay some on a quarterly basis, we pay some on a monthly basis. For instance, we pay rent on a quarterly basis. Salaries and on-costs are paid on a monthly basis. Recruitment costs, we pay them occasionally. Equipment, we buy them as and when we need. And so the same happens to materials, which we also buy as we need them. So timing is what changes a budget into a cash flow forecast. And I'm going to try and take us through this little example of a cash flow forecast. We're running a project for a year from April to March. Okay. What we do is we sit down and we table all the incoming resources. And we know that the incoming resources come at different times of the year. So, for instance, the money from national lotteries will come to us in August. The money from London Boroughs grants will come in May. The European Social Fund comes in June. The Bearing Foundation, we get some in April. So we list when it is that we expect all our funding to come in, the months that they come in, and we make that table based on the month. So we know that 18,000 in April, 13,000 in May, 31,000 in June, 35,000 in July, and we go on, and we have a total of what would have been our budget. And then we look at how we expend the resources. For instance, staff costs are paid on a monthly basis. Training and recruitment, we do it at the start of the project. External trainers and staff costs, we do it at the start of the project. Conferences and facilities that we do it maybe in March. Communication cost is maybe every quarter. Reports and newsletters that we subscribe to, again, we allocate for the months on which we expect to spend the money. And then we have funding for postage, fundraising activity, telephone and internet costs, service charges, and fixed assets when we buy them. So if we take a cash flow forecast, we'd realize that in April, we received 18,955 pounds comes in April. And we expend 32,260. And so for the first month of that particular cash flow, we have a net balance of 13,305 pounds. We are lucky that we've brought forward a balance of 15,000. So the balance that carries forward is not a negative balance. It's a balance of 1,695 pounds, which we take into the next month. Again, in the next month, we spend more money than comes in. So we have a deficit of 17,000. And we'll realize that in this month of May, what we bring forward is only 1,695 pounds. So for that month of May, we are likely to have a deficit of 15,000. Because we have presented this particular cash flow for the bank, and because the bank realizes that we are going to have a more favorable balance in later months, they may be able to assist us in terms of covering an overdraft. So in June, 31,000 comes in, but we only spent 13,000. In July, 35,000 comes in, but we only spend 20,000. In August, 21,000 comes in, but we spend 14,000. So what we have is a rolling balance, which shows when money comes in, when money goes out, and we realize that we started with 15,000, which is brought forward. We end up with 16,000 that we've made a surplus during the period. And so we end up with a cash flow, healthy cash flow forecast of 31,073 pounds. So cash flow is more about timing than about anything else. I hope that the difference is clear to us. And let me now that I've dealt with some of the figures, before I deal with variance, let me say that budgets need to be monitored. So we review the budget. And one tool that I'll comment on is the tool of variance analysis, which is a tool that is used to control budgets. And it enables us to amend the budget in the light of new information. And decisions are then, we are then able to take decisions based on the variance analysis. And we then realize that if there are any problems, we're able to amend the problems so that we are not able to jeopardize our future funding. Okay. Variance analysis explained is that when we got a budget and we compare the budget to the actual, we realized that we expected to spend 57,000 for salaries, but we spent 60,000. So there's a variance of 3,000. Equipment, the same, there's a variance. Travel, there's a variance. Training costs, there's a variance. And what variance analysis does is that it asks us to ask questions about why there's this variance, and for us to be able to have credible answers. So, for instance, the staff cost may be higher than expected. What are the reasons? Why is there no allocated cost for administration, but we end up with a budget of 8,650? Okay. Then we look at the total positive cost of 6,056. And it may be a mistake. So at least we look at it. And trading costs may have been overspent, but that's because maybe we held just one event. So the critical wheel is that when we take the budget, we look at what the variance is, maybe on a month-to-month basis, and we are able to allocate reasons for why we had that variance. So variance control is something that we should use, you know. The benefit of cash flow is that we are able to integrate and evaluate the effect of our planned activity. It enables us to anticipate what our cash surpluses are and deal with them, or whether we are going to have any budgets. It enables us to compare our actual performance to our budgeted performance. We are able to identify unplanned events. We are able to establish efficient planning procedures, and we are able to determine whether our offering is efficient or inefficient. And we are better able to calculate our funding requirements so that we can promote a forward-looking organization. And I come back to say that before we start looking for funding, we need to think about our next application. Are final records ready? Are they tidied up? Do we have management accounts? Are budgets accurate and reasonable? Have we covered all our costs? Have we shown a track record for delivery? And can we manage the funds when they come? Thank you very much for listening to me. I think it's been long drawn out, and I will now stop sharing my screen and take questions. Thank you.